Hello and welcome to Sectors Up Close. I'm Ramzan Karamali. Today we're focusing on US-listed Chinese stocks, and my guest is Joachim Klement, Head of Strategy at Liberum Capital. China announced this week what many analysts deemed a modest growth target for 2023 of around 5%. That target was set at the annual National People's Congress and was the lowest set in more than 30 years. However, it's worth remembering the world's second largest economy grew by just 3% last year, one of its worst showings in decades, as it slowly emerged from 3 years of COVID-19 restrictions. The iShares MSCI China ETF, which tracks some of the most well-known Chinese stocks available to international investors, lost nearly a quarter of its value in 2022, but since its lows in October, it has risen roughly 40%. But growing tension in Chinese-US relations will surely worry investors. Only this week, Beijing told the United States to change its distorted attitude towards China, or conflict and confrontation would follow. Well, Joachim Klement is here from Liberum Capital and can help us analyse all this. First of all, I guess the most obvious question, can US investors trust the Chinese government?
Oh, they can absolutely trust the Chinese government to do what is in its best interest strategically, just like most governments will try to do what is in their best interest strategically. And for China, that means, and that is something that has not been widely reported from the last People's Congress, to achieve this whole nation status, which means basically to become independent in crucial technologies and supply chains from the West and to insulate itself from any kind of blackmailing opportunity that Western countries might have towards China.
You talked about technologies there. Only last October, the US Commerce Department banned the use of Chinese technology, Chinese microchips. How is that working out? How is that having an impact on Chinese stocks going forward?
Well, we already are in kind of a cold war when it comes to some of these technologies. The US has also introduced last August the Chips and Science Act that basically gives subsidies to Western companies building semiconductor factories in the US, but only under the condition that they don't deliver advanced technology to China. What that means is that some of those Chinese companies, and in particular here Tencent is somebody to mention, is not just under pressure from the Chinese government due to competition concerns and monopolistic competition in China, but also will have a much harder time doing acquisitions in the US and in Europe going forward. And that hampers the growth outlook for companies like Tencent, which rely on high growth, especially outside of China.
Well, going back to China, that target, that modest target of 5%, is that another thing that investors should worry about?
No, investors need to get used to the fact that Chinese growth is systematically slowing down for all kinds of reasons. The one well-known fact is the demographic problem with an aging population, but also the fact that China has caught up a lot of the gap to industrialized nations, and that means that your starting level of GDP is higher and your growth rates will eventually have to come down. We think that towards the end of this decade, Chinese growth will decline towards 4%. So we will not go back to these kind of 6% or higher growth rates in the next 5 to 10 years.
I mentioned at the start about the iShares MSCI ETF. It's had some ride over the last year and a half. Can investors really put all their money in things like this? Can they really trust to go back into these Chinese names, denominated in dollars?
Well, it depends on your investment horizon. Tactically, over the next couple of months, these stocks I would expect to continue to rise. And that's mostly a result of the Chinese reopening, of the economy kind of getting back into full swing after all those COVID lockdowns. That benefits index heavyweights like JD.com, like Alibaba, and also to some extent Tencent. But if you look at it from a 3 to 5 year perspective, the problem is that domestic growth is slowing down, as we just discussed, but also that these companies will have more and more restrictions for growth outside of China, and that limits the outlook on a 3 to 5 year basis.
And just finally, if you want exposure to China, there are other ways of doing it. You could perhaps buy stocks that are foreign stocks that are exposed heavily in China. Is that a better way of doing things? Is that as rewarding a way of doing things?
It can be as rewarding a way of doing things as investing in Chinese stocks directly. If you have companies classic companies are luxury retailers and car manufacturers, which are heavily exposed to Chinese consumers. And for them, it can be a really rewarding way to invest in China through that channel. However, the key thing, going back to the geopolitical tensions that are rising, is if we are getting more and more towards an increasing trade war between the West, the US most importantly, and China, a lot of these companies will face difficulties both from their own home countries trying to curb exports into China and from China producing customs and trade barriers in order to hamper their business. So you have to watch the situation more carefully, but one thing is clear, Western companies with big exposure to China are easier to invest in than Chinese companies.
Joachim Klement from Liberum Capital, many thanks for your time. And that is your roundup of US listed Chinese stocks. I'm Ramzan Karamali, and this is Reuters.